Good afternoon, everyone, and thank you for attending this talk. My name is Santi, and I'll be walking you through a beginner's guide to fundraising and valuation. And I work with Foxmont Capital Partners, and we invest in early stage Philippine startup companies. And we've seen our fair share of what makes deals attractive and unattractive. And so for today, we're going to be going through different topics in fundraising. But before I get started, I wanted to ask the audience four questions. So first, if you're an entrepreneur, I want you to ask yourself, how do you know if you're ready to fundraise? Next, what exactly do you need? Apart from capital, do you need a network, expertise, mentorship, or guidance? Fundraising would be a good opportunity to take advantage of to receive that. What are you prepared to give up in return for what you receive? And how much is your company valued? So we'll be discussing nine different topics about fundraising, and I will attempt to give you a crash course for each. So the first one, we will attempt to answer the first question on how do you know if you're ready to uh, for outside investors. The second one, for the second topic, we will explore all your options for funding. The third, we will go through the standard contents of the pitch deck. Fourth, understand the basic terms and conditions of investment agreements. Fifth, how to identify the right investor for you. Sixth, what information to prepare in order for an investor to do their own review of your company. Seventh, what's the timetable to expect and what are the steps in the process. Eighth, how to arrive at a valuation that's acceptable to investors. And number nine, final remarks and pointers before you start your fundraising process. So the first one on getting ready, um, what are the minimum requirements? Of course, you need an idea, you need a team, but more importantly, prepared to commit long term and full time. You also need to have the right intentions. You're not out to fundraise just for a higher valuation or um, a payoff, but rather to scale and to grow. And finally, for investor relations, you need someone who is willing to take charge of the role of managing relationships with investors. And this is not necessarily as a CFO, but someone to be, I guess, remain attentive to investor questions. Finally, like I think at the safe state, you want to be considered a startup company. So that means you have an innovative business, product, or process. And you're usually technology oriented and definitely highly scalable. If you're not a startup, it's going to be hard to fundraise. Fundraising through venture capital angel investors might not be suitable for you. Of course, you need a business plan. You need to have an achievement of at least one milestone, I think, is important. So whether that's in sales or uh, some other operating metric that you achieve, you need a clear path to profitability and sound accounting practices. So you have to make sure that you maintain a single record of or single book of accounts and make sure that they are audited by qualified accountants. Ideally, you want to have traction and show hockey stick growth in your pitch. Of course, highly scalable. You need to have a proven track record. Majority ownership is very important because it gives an investors an idea of your skin in the game. And of course, your financials are organized. So this is the global context. In the Philippine context, I think that the minimum requirement is on safe state bubble because Philippine investors are still on the very conservative side. Um, and so you want to make sure that your business is definitely more than ready for the conservative investors. Next, exploring all your options. So conventionally, you can raise funds internally or through bank loans, investors, or accelerators and incubators. But I think you need to keep your eye out for alternatives like competitions and contests, crowdfunding platforms, government grants, and actually even product pre-sales. So selling your product in advance, raising that money, and promising to deliver the product in the future. So for today's discussion, we'll be focusing on how to fundraise from angel investors and venture capital investors specifically. So here are the standard contents for pitch deck, which I pretty much got from Forbes.com. So I would think that this would be applicable to no matter where you are in the world. However, I've included number 16 and 17 on use of funds and COVID-19 impact. For the team, remember to specify who are the part-time members versus the full-time members. The problem, I think, should be understood at a glance and make sure it's as relatable to anyone as possible. The product, I would suggest to show a demo and really allow the investor to fully to have the full experience of the product. Never say there's no competition. I think when presenting your competition and talking about it, uh, manage to put something there. For the business model, be clear with how it will generate sales. So this is outlining your revenue streams. And this has to be clear cut and you cannot afford to be abstract. In terms of financials and metrics, always include historical and projected. Of course, you want to be as realistic as possible in terms of how you make your projections. But I think if you want to show the promise that your company can bring, my tip would be to create a base scenario and an optimistic case scenario. Be specific about your ask. So we are seeking X amount for Y% of the company. As an example, use of funds, always add a buffer in determining your capital requirements. So let's say if you outlined all of the expenditures that you're going to make, and you arrive at 490,000 US dollars, I would round that to 500,000. So it's easier to remember, and you also have some kind of buffer for unforeseen expenses. And of course, during this time, you might want to include a slide on how you will take advantage of the current environment. Keep it as simple as possible. You want the pitch to be easily remembered so that so that the business is easy to talk about, especially in the investment committee meetings of the investor. You might want to prepare for both a standard version and keep that up to maybe 15 minutes and well within human attention span, and the short version just in case you participate in contests or competitions. Never underestimate the value of aesthetic because I think it gives the investor an idea of how serious you are about fundraising and how serious you're taking the relationship with the investor. Very important to clearly distinguish what exists today about the business and what has yet to be developed. So investors need to know what exactly they're buying into, and it will be hard for them to invest if they discover later on that only 10% of what you showed them is what was developed so far. Some other suggestions of slides: risks, outlining your risks and outlining how you will address them if they come to play. SWOT, or strengths, weaknesses, opportunities, and threats, and even scenarios for your financial projections. So I think another tip is to make use of annexes for slides if you don't need. So for purposes of presenting, focus on what you think is most important and annex everything else. So that way, during Q&A, you have a chance to bring it up again and discuss the contents of the slide. Always send as a PDF and not as a PowerPoint. You may also want to consider sending it as a link so you can track viewership. And finally, you can view other pitch decks online, such as that of Facebook and Airbnb, and just to draw ideas on how to make it most presentable. So next, the term sheet. What is a term sheet? Term sheet is basically a document that summarizes the basic terms and conditions between the investor and the company. And you have two aspects of the term sheet. The commercial aspect would outline things like about the investment, what rights you're willing to give the investor, what promises you're willing to give the investor, how you promise to use the funds, how the investment will be documented, and so forth. And so this answers basically the questions 2 and 3 earlier on. What am I prepared to give up, and what exactly do I need as an entrepreneur? And then also your legal terms, right? So the commercial aspect and the legal aspect. So the legal aspect, I would always recommend to get a lawyer's opinion or have a lawyer review the legal terms. The term sheet governs the direction of documentation. It's usually non-binding in practice, but I would recommend to still specify it for best practices. It serves as a starting point for negotiation. So the term sheet's usually done at the beginning, from when an investor says that they're interested. The term sheet is normally finalized in that phase of the process. You must prepare this before you begin fundraising, so that you know what your limits are in terms of what you're prepared to give and what you're prepared to receive. Always have a second review if this document comes from the investor, and make sure that you understand every line and every word that's on the term sheet. And most importantly, before you finalize, ask yourself, how will the terms affect your next fundraise? So, for example, if you receive a valuation of $1 billion, at your seed round, right? Ask yourself, how will I be able to achieve a valuation above 1 billion in my Series A round, right? So the terms today will affect your terms in the future for sure. So I think choosing your investor is like, or entering into an investment agreement is like entering into a marriage. And so you want to make sure that you properly choose your investors correctly. So first, you want to do your research. Some investors are generalists, but some investors focus on particular growth stages, sectors, or even geographies. So sometimes you might have a meeting with an investor who, where it's not suitable, their parameters are not suitable to you. Corporate investors usually take a bit more time in their due diligence and approval process than individual investors do. However, they may have more resources at their disposal. You also want to make sure that you attract the right investor in terms of how sophisticated they are. Um, so usually sophisticated, what I mean by sophisticated is that investors are usually objective driven, while unsophisticated investors are usually emotionally driven. So sure, it might be easier to sell your product to the unsophisticated investor and entice the investor through emotion, and I guess a connection to your product, but it's going to be harder later dealing with them later on when things go bad. Do you want an active investor or someone who's passive? It's important to understand the kind of chemistry you'll have going forward. Financial investors usually take a minority stake and have an exit plan in the next maybe 5 to 10 years. While strategic investors may take a minority stake at the beginning, but usually plan for a majority stake in the future. So you also want to understand what the real intentions are behind the investment. Finally, behavior. Are they collaborative or are they demanding? And I think it's always a good idea to um, for ask around maybe other startup entrepreneurs how their investors have been treating them so far. So I think when an investor goes through their own review of your company, they usually look for certain documents, and you want to prepare this online in what you call an online data room, usually in the following categories, right? So you have your business information, your pitch deck would be in there, your corporate documents and incorporation documents, um, your financial statements, your financial model if you have one, uh, information about operations and technology, your contracts, whether that's your most important sales and client contract, or even your contracts with other vendors like your lease contracts or even security contracts, and any other document signed. Actually, I would recommend to upload them into this folder. If you have any loans, outstanding loans, place them there. And in terms of organization, you want to include the resumes of your founders and your senior management team, the organizational structure, and the shareholder structure. Next, timetable. So once you get everything organized, meaning you have number one, your term sheet, number two, your pitch deck, number three, your list of investors that you want to approach. Uh, then the next thing to do is to start pitching, right? And I would allot 1 to 3 months for pitching. And this is usually the length of time, I think, would depend on how soon you need the funds and I think also how much funds you want to raise. You want to allot 2 to 8 weeks for investors to conduct their due diligence. And the due diligence process would really should depend on um, the amount of information that needs to be reviewed. Right? So if you're a startup company would have less information to be for review than a larger company would have. You want to allow 2 to 4 weeks for documentation, and usually this is done by both um, lawyers from both sides of the table as well as yourselves. You want to allot at least 1 week for the signing of the documents, and usually while this is done in less than half a day, um, given the number of people reviewing the document, there's always bound to be at least one person who raises last minute revisions before signing. Then, of course, the receipt of funds should be pretty straightforward once the documents are signed. But this is usually done within 1 to 2 weeks after. So, in terms of valuation, I think the most important principle in valuation is that valuation is a balance between art and science, meaning it is actually more subjective than what most people might think. However, and so I think there's no one right way to value um, any business. It's not one shoe size fits all. It needs to be done on a case to case basis. Now, with that said, let me give you three conventional approaches investors are used to. The first approach is the cost approach, and here you're asking yourself, or here the investor asks himself, how much would it cost me to build the same business? Um, the problem with this is that team value and brand value become highly subjective, and it also fails to account for the time it would take the investor to build the business, and also the future cash flow and earning potential that the business can generate. The second approach is the income approach. And here you're asking yourself the question, how much income can I expect to earn from now and in the future? And this is basically like simple time value of money. I call it the time value of money approach, where you project your future cash flows and then discount it to present, and you arrive at your valuation. So if you want to look into this method, you want to search up the discounted cash flow approach or the dividend discount model and find the formulas for these. The I think the issue with this approach is that it's usually tedious to calculate and very highly sensitive to assumptions. So the third approach is the relative approach, and here you're asking yourself, how much should I value the company relative to other companies? So here you apply value to metric multiples of similar companies. So you have trading, transaction, and operating metrics. And so, for example, you can use something like price to sales or value to sales, value to annual sales or value to annual earnings. So this is very similar to the way you would value land, right? In terms of price per square meter. When you're trying to, let's say, value a certain lot, right? You'd value it based on neighboring lots, right? Okay, what is the value of neighboring lot? What is the price per square meter of neighboring lot A, B, and C? And then you gauge, okay, maybe with these three different prices per square meters, I can probably estimate that the closest price per square meter from my lot would be X amount. Just some final reminders. In terms of pitching, I would recommend to take a tailored approach. In other words, do your research and background checks on your investors first before agreeing to have them over as an investor. Because an investment is like a marriage and you'll be dealing with them for years. Um, and so it's important that you like not only how skilled they are as investors, but also how they are as people and how you get along with them. Always get an introduction also, rather than a cold email. Introductions increase your chances by a significant amount. Uh, Always remember also to try to captivate your audience within the first 5 minutes of the pitch. I would also recommend that midway you might want to ask, hey, is this something that you would consider looking into? At least that way you might save some time if the investors' investment parameters are not suitable to your company. Take the chance to talk about synergies and how the investor could help you. I think that would be, it might be attractive to them also. Like, hey, I know that your, partner so and so is an expert in this field, and I think that that partner can possibly introduce us to, so and so in the future. Then again, always practice and refine. So I would recommend approaching investors who you're not so serious about for your first few pitches, and then developing a rhythm and building momentum and understanding what the frequently asked questions are and what red flags do they see about your pitch. In terms of handling rejection, there will be a lot of this, so prepare. Um, Prepare emotionally. Uh, Note that 99% of pitches get rejected. So if you get an investor to be interested, congratulations, you're part of the 1%. Um, I would also recommend asking a last resort question, which for me would be, okay, thank you for your time, but what would it take? Uh, what can I do to have you come in as an investor? Like, what would it take? What can I offer? Take the chance to ask for feedback um, about the pitch. Uh, Always ask for referrals. Also, whether in business or in terms of business or in terms of finding other investors. And it would be a good idea to maintain a close relationship with them. So ask them permission to, if you could update them maybe quarterly, or even just update them when the next fundraising round comes. Then just finally, general reminders. Authenticity is very important. I think the more authentic you are, the more marketable you become. So I think even if you have quirks, flaunt your quirks because um, I think I think attracting the right investor uh, also means making sure that they're okay with whatever quirk you might have. Honesty, I think, is pretty obvious, and it's easy in concept, harder in practice. I think the harder challenge here is being honest with yourself and being honest with the targets that you can meet. Um, when dealing with hard questions, take proactive responses. So um, if, for example, they ask a question about threats for competition, you better respond with you could at least respond with ideas on how you can address them or ideas on how the investor can help you address them. Know your numbers, sales, net income, profit margins, burn rate, run rate, uh, and so forth. Finally, be responsive and attentive to investors. Uh, since since you might expect to receive more questions after the pitch. Good afternoon, and thank you for joining us today. We are very thrilled to have you with us to celebrate Philippine Startup Week and the launch of our industry report. At Foxmont, we believe in the value of investing in the Filipino and that venture capital investing should be centered on the entrepreneur. It is our initiative to support the startup ecosystem not only with our resources, but also by promoting awareness of our country's progress and encouraging participation from regional investors. With this, it is an honor and a privilege to present you with our country's first Philippine Venture Capital Report that focuses on investing activity and startup trends in the Philippines. Our report launches in the midst of one of the most significant global challenges that we will collectively face in a lifetime. We keep everyone in our thoughts as we navigate through this new normal. We do appreciate that it's a difficult time for all, and we present this report with the greatest sensitivity. Deal flow and venture capital activity seem secondary to the collective challenge that we all face, but we do continue our support for the local community. It is interesting to note that despite the rapid spread of COVID-19, there was still some marked movement and growth in deals. This report will introduce many of the major players in the Philippine startup industry, from the various established and nascent funds and the startup companies that are beginning to take hold. Despite the economic burden that the pandemic has placed in this country and all others, we found one thing to be clear, that startup activity in the Philippines has matured significantly in a very short period of time. Over the past 3 years, we've seen local conglomerates announce new venture funds, the establishment of the Venture Capital and Private Equity Association of the Philippines, and the Manila Angel Investors Network, both created to organize and structure the investing side of the industry. Additionally, this ecosystem as a whole has jumped 17 global positions to rank 53rd in 2020. Meanwhile, on the startup side, there's been significant activity that's been rarely seen before in the Philippines. Locally founded companies have exited, while newer companies have found strong support locally and even regionally. The increased investing activity in the industry mixed with the challenges related to COVID-19 truly make this a unique time for innovation in the Philippines. We hope you find this first edition of our report insightful and helpful. The primary objective of the report is to provide investors with a starting point as they evaluate investing in Philippine startups. For foreign investors, the report serves as an aid to their due diligence process and in obtaining internal approvals for market entries, and provides a wide array of contacts that they can connect with. For local institutional investors, the report promotes startup companies as an increasingly viable and investable asset class. For local individual investors and stakeholders, the report provides a front row seat to the developments of local innovations and promotes opportunities available to aspiring entrepreneurs. With these objectives in mind, the contents of the report are built on three pillars, or three I's. The first pillar is information. Here we provide data and analysis on venture investing activity and provide answers to frequently asked questions from investors. We discuss the startup ecosystem as a whole, historical deal volume, participation by investor type, deals by growth stage, deals by geography, and sector discussions, among others. The second pillar is insights. We share our interviews with various stakeholders in the ecosystem, from venture investors to startup founders. We provide a door to the minds of industry leaders as they answer important questions on the investing landscape. The third pillar is inclusion, and here we provide learning materials for those who are not as familiar with the startup community. We cover topics like what is venture capital and tips when making an investor pitch, among others. On a final note, the report will be made completely free and available to the public and can be found on our website at foxmontcapital.com, our LinkedIn page, and through our distribution partners, Kubo Innovation Hub, PwC Philippines, and our publication partner, Esquire Magazine. Thank you very much, and we look forward to answering your questions.